It was another solid day on Wall Street as we saw the S&P 500 up over 1% today. That did take us to a new one-month high for the market since bottoming out late 2018. We saw the Nasdaq up even more than the S&P 500 today because Netflix decided that they're going to be raising subscription prices, and Wall Street cheered that on, so it sent the Nasdaq up even higher. Netflix has been one of the strongest stocks over the last month, up basically 50%. We also saw some news out of Brexit, and we saw some decent earnings reports coming out from the banks. So there are a lot of different things to discuss here tonight. In our trade application, we're going to take a peek at a beaten down technology sector stock that is trying to find a little bit of a bottom here recently. And if it does break out to the upside, we'll try to take advantage of that. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 15th, 2019. First of all, if you're new, welcome aboard. We're grateful to have you in our audience tonight. Remember, you can go to YouTube, and while you're there, subscribe to our channel and also check out our link in our description area that helps you sign up for our email distribution list. In addition to that, we're heavy users of Twitter. Make sure you're following me there at Brandon Van Zee is my handle. And if you get value out of these daily videos here, make sure you're liking and retweeting the tweets that are focused on the Market Outlook video itself. That really would do us a lot of favors. In addition to that, we have a presence on Facebook. Feel free to join our group there. The address is embedded in that logo in front of you. All right, let's go ahead and dive into the charts. As you can see, I've got the chart 4B pulled up here for those of you that are premium market scholars following along at home. As a reminder, for those of you that are somewhat new, we're looking at 4 different U.S. equity indices here with these 4 different charts. Each one of the charts are 3 months in length. Each one of the candles that you see is a daily candle. And so in the upper left-hand corner, you can see the S&P 500, like I mentioned in the intro. It was up 1.07% today, a pretty solid day. And so we retain our bullish postures across the board. As you can see, not only do we retain our bullish postures, but you could say we're retaining our strongly bullish postures. Remember, there is a distinction between this part here and this part here. This is a lighter green color. This is a darker green color. And what is distinguishing the two colors there in that case is whether the intermediate line, which is kind of our default line that we look at when establishing our posture, but do keep in mind that's for an intermediate term trader. So if you're not an intermediate term trader, then perhaps you're going to use a different line, like the blue line might be a little bit better for some of you swing traders out there as an example. But anyway, when we say we have a bullish posture on the S&P 500, unless we say otherwise, we're referring to the intermediate term posture that is being established within this market forecast indicator down below here. And remember, you can find that market forecast indicator on the Thinkorswim platform or other TD Ameritrade platforms. So as you're looking at this, what we're trying to determine is whether the green line is going up between the 20 and the 80 zones, which are kind of the areas that represent, in this case, above 80, the upper reversal zone, and in this case, below 20, the lower reversal zone. So as you can see here as an example on the S&P 500, we are trending higher between 20 and 80. And what is the distinguishing aspect between the light green and the dark green on the chart is whether we are traveling higher between 20 and 80 and below 50 or above 50. So when it's below 50, but we're still traveling higher with the green line, that's when you're going to have that lighter green shade of the background color that tells you that we do have a bullish posture, but it's just a weakly bullish posture that could be a bit tenuous, and it could turn around relatively easily. Once that green line gets up and over the 50 percentile area, or the midpoint of that chart down there, then it starts turning the background color dark green. And you can also see that, by the way, in our labels right here where it says the intermediate line right now is at 54.58 and rising. So since it's rising and also above 50, then that's why we have that deeper shade of green right there. So the point is, across the board with all 4 of our equity indices here in the United States, we have strongly bullish intermediate postures. Now, price action could certainly be better. You know, obviously we're still a long ways from hitting the highs that we established last year, but if a market is ever going to bottom, it's got to start with a process. And this could perhaps be that process as it tries to gear back up towards those highs that we did see in 2018. So that's a good sign. And as you can see down below here, this is what I was mentioning as well with the NASDAQ. Notice that big move out of the NASDAQ right there. That's a 1.71% move right there. So that seems to be one of the leading areas of the market right now, which is a good sign. It's a good sign of, it's a health check of the market. Remember that there are different ways to gauge whether people are willing to take risk and whether animal spirits are alive. And a lot of times you'd like to see the NASDAQ do better than, let's say, the Dow Jones or the S&P 500. You're also finding that the Russell 2000 is hanging in there along with the Dow. Although the Dow, you'll notice, just got that darker shade of green here just yesterday. So it was kind of the laggard in this most recent move, whereas the other ones have had a darker shaded color here for a longer period of time. So I guess the point is we still remain in a fairly strong market, and there are still a lot of people gun shy. There are still a lot of people that believe this is just simply a trap of sorts and a dead cat bounce. If you go onto Twitter, you're going to see all types of people saying that, and it very well could be. But we have to also recognize the possibility of that not occurring. Perhaps that was the bottom that we saw a month ago, and perhaps we are on our way to recovery, and you have to ask yourself, what position do you want to take on next for your portfolio? And right now, with the strength that we've seen, it can make some sense to have bullish positions in your account. After all, we've got bullish postures. We've also got price above those moving averages in all four of those cases. Let's take a look now at our 3 green arrows chart setup, which will be chart 4C. And as you can see here, we have 3 green arrows across the board as well. We've got 3 green arrows on the S&P 500, the Dow Jones, the NASDAQ Composite, and the Russell 2000. And just to catch everybody up to speed, what I'm referring to with the 3 green arrows is 3 different technical indicators that we oftentimes look towards once we're trying to implement a trend trading style or strategy, somewhat similar to the top-down trend trading class that I teach for my clients on Mondays. There we are trend traders. We're looking for charts that have a series of higher highs and higher lows. And so generally we want to kind of establish the foundation of whatever stock that we're going to buy by trying to determine whether the markets themselves are healthy enough to consider trend trading. And right now, judging by the 3 green arrows analysis, where we've got the 30-day moving average giving us a green arrow on the MACD, and a green arrow on the stochastics, then these are healthier signs. Again, not perfect, but rarely will we encounter perfect conditions out there. So we have to do the best we can with the information we have. And right now is a decent time to be looking at some of those trend trades out there. Let's take a look now at our next chart setup, which will be our 1040 crossover method. Remember, this is a longer term view now. Each one of these charts, 3 years in length. And each one of the candles that you see on the charts represents 1 week in time rather than 1 day. As we look at these charts, you can see that the most recent color being plotted on the background of the charts are pink. And what that is notifying the viewer of, or you in this particular case, is that we do have bearish 1040 crossovers. And that is a longer term view. That is not a very sensitive view, so you're never going to catch the bottom or the top. You kind of have to wait for a lot of information to be inputted into the system before your triggers change. So you have to understand, both the strengths and the weaknesses of any strategy that you might be implementing. But the general idea of this 1040 crossover method, where we're applying a 10-week exponential moving average versus a 40-week exponential moving average, is that we're trying to capture the juicy meat on the bone in the middle. We know we're not going to grab the ends of the bone, but in the middle of the bone, there's some juicy trends that are often available for investors. And you can see that those trends did last for quite some time. In all 4 of these charts cases, we saw some excellent bullish price action basically between, let's call it the spring of 2016 up until the fall of last year. So, that was 2.5 years worth of bullish price action there that unfortunately now has been unwound now that we've kind of gone into some of these more difficult market periods. But I will say that if you look at the MACD 2 lines, which we've got plotted below each of the graphs, that is going to tell you the distance between the orange line and the blue line on the charts. Again, the orange line is the 10-period exponential moving average, the blue line is the 40-period. And when it curls higher, like it is right there, and when it curls higher, like it is there, and down here it's even more pronounced, and down here it's even more pronounced, that is telling us that the more sensitive line, in this case the 10-period exponential moving average, is now bending back up and going towards that blue line again. So that is generally perceived as a bullish thing because it's telling you that in the short term, the bulls have kind of dug in their heels and are willing to kind of fight back against the bears a little bit more so than they were willing to do late last year. So we'll have to see where that takes us. That is a positive sign, but just to be clear, at this moment in time, it would still be considered bearish according to this specific strategy from a longer term perspective right here. All right, let's now take a look at our next chart, which will be chart 4E, and this is our intermarket analysis 12 grid. As a reminder, when we're looking at these miniature charts here, the background color will tell you whether we have a bullish posture or a bearish posture using that same intermediate line philosophy that I mentioned before. Remember that this first set of 12 grids that I typically review during these videos is going to be outside of the stock market, and then we'll kind of hone back in on the stock market itself. So here, we're going to see different things like bonds, commodities, interest rates, different things like that. So anyway, what I typically try to do is just look to see if there's anything that stands out to my eye as far as either big one-day movers that I should be aware of, big trend reversals, trend continuations, or anything along those lines that catches my eye. So, as I look at this 12 grid right now, I would say that one thing that looks somewhat interesting is up here in the upper right, an area that we haven't talked about quite as much recently because it's largely been bearish trading for the MLPs. Those are your master limited partnerships. Oftentimes they're pipeline and storage related assets within the energy space. Remember, check with your tax advisor whether it's a right situation for you to be trading those or not. But nonetheless, it is an area that does provide income and a few other things. And notice that while we had been stuck in this series of lower highs and lower lows for much of the last 3 months, that here just today we had a nice little bounce back after a little bit of a flag that was forming right there. So notice this could have been described as a bit of a bull flag, if we're going to be looking at it in hindsight and we see AMLP, launch higher from where we currently are trading, which is 9.71. Now remember, this is an ETF that tracks MLPs. There's a ton of individual MLPs out there that you're welcome to look at as well. But I would say that's a positive sign. We had this really big reversion to the move, or reversion to the mean move, to kind of get us out and unwind us out of this downtrending situation, right? The expectation would have been a bounce from here, which we got, but it wouldn't have necessarily been the expectation that it would have continued through that moving average. After all, it failed the moving average there, and there. So we would have expected that when it came up to the moving average here, it would have failed again and continued in that series of lower highs and lower lows. But that's not what the trading gods had in store for us. Instead, we sliced straight through that moving average, went way above it. Then it decided it wanted to pull back, and it did that for the last 3 days. But it did not reestablish new trading below the moving average. So that's a very positive and healthy sign there. Also notice that the moving average itself has now tilted higher. So we now have a situation where we have a bullish posture on AMLP. We have what could be kind of a bull flag type of a situation establishing itself here, and we have price rising above a rising moving average as well. So a lot of more positive developments there with master limited partnerships all of a sudden. Speaking of kind of commodity related types of securities out there, there's gold. We've been keeping our eyes on gold quite a bit down here on the bottom rung. Gold has held the line. It continues to go sideways, and so I'm not willing to give up on it quite yet. There's been some interesting merger activity. Some of you might have caught in the gold space here recently. A few weeks back, we saw Rand Gold and Barrick Gold get together officially. And then I think it was just yesterday, it was announced that Newmont Mining, which is the only company, the only gold mining stock in the S&P 500. Remember, a lot of gold mining stocks are based outside of the United States. But Newmont is based right here in the United States, does a lot of mining in Nevada, but it, of course, has got operations around the rest of the world as well. But anyway, they are going to be buying Goldcorp. Goldcorp is a huge gold mining company up in Canada. And so we've had some major deals. I mean, those are some of your biggest names in the entire gold mining space. And so it appears that there's consolidation taking place at a time where gold prices are continuing to rise. So keep your eyes on the gold mining space. There could very well be some interesting opportunities there if you're looking at the right charts. Let's take a look now at our next 12 grid. In this case, we'll go on over here to chart 4F. This will be our foreign stock markets 12 grid. And as you can see here, everything except for India in the green right now. When I did this video last week it would have been Thursday, India did have a green background at that time. So at this point, you can see the intermediate term line is now at 74.95 and falling. And so that's something to keep your eye on. At this exact moment in time, it looks like it's kind of contending with that moving average. So I don't think I'd necessarily write off India quite yet until I see a more consistent break to the downside. But the good news is the rest of the world is kind of hanging in there just fine, at least according to the market forecast intermediate term line. We've been kind of identifying a few of the countries here recently that have a little bit more strength than the others. Generally speaking, we've been talking about Brazil, which is the one in the upper left. That continues to do reasonably well, hanging out near 3-month highs right now. We've been talking about Mexico, not necessarily at a 3-month high, but the reversal that Mexico has had off of its bottom have made you sit up and pay attention to it. So, keep your eye on Mexico as well. That still looks pretty healthy down there. And then also down below here with South Africa has been pretty strong. And it hasn't broken out yet, so that's kind of that level that I was discussing with you guys last week, where we're kind of waiting to see, is South Africa willing to break out beyond this level and this level from the past? We haven't seen it yet, but it hasn't necessarily failed either, right? It's spent a little bit of time for the last, let's call it 3 or 4 days or so, just kind of biding its time around this area, but it hasn't decided if it wants to go up dramatically or down dramatically yet. But again, keep your eye on it. Going back to my previous conversation, those of you that have followed the gold mining space in the past know that South Africa is one of the key gold mining operations across the globe. There are a number of publicly traded companies that are headquartered in South Africa. So if that gold theme continues to kind of present some resilience or even strength going forward, just like it has in the last few months, then we might very well start seeing some of these South African companies breaking out to the upside as well, which might lead EZA, which is the ticker symbol of the ETF that tracks South Africa, also rise in sympathy. So keep your eye on South Africa. All right, let's now take a look at chart 4G, and this is our U.S. sectors 12 grid now. And as you can see here, the only two problem areas that we have are materials and utilities. Now, of course, those of you that have been following the news flow here recently, especially those of you out west, will know that PG&E, which is ticker symbol PCG, I believe. It's a big California-based utility company, is likely going to be filing for bankruptcy. And I think that has somewhat kind of pressured that entire utility space. But it's also true that as the stock market has become more comfortable with taking on risk again, a lot of times utility stocks get sold, right? That's a place where a trader could generate cash, right? A trader might have moved into utilities late last year as the stock market itself was getting blitzed as a relative safe haven. When that trader decides that the coast is clear and they're willing to take on more risk again, they might use that utility as their cash slush fund and sell those utility stocks that they bought in the past in order to finance trades in riskier areas like Netflix or other technology or communications related areas. So anyway, those are the two areas that technically have a bearish posture according to the intermediate term line on the market forecast. The other sectors all have very good strength. We have some bullish postures across the board there with the rest of them. Do note here that technology did close with today's move. So technology, which is XLK, was up 1.51% today. So it was one of the bigger movers of the market here today, along with communication. So again, remember the net Netflix effect up there with a couple of those areas. But anyway, I just want to point out that technology not only has a bullish posture according to the intermediate term line, but we did close above that moving average as well, and that has been somewhat rare and hard for that to do. I'm pointing that out now because our trade application example is going to come from that particular area. Now, real quick, just a reminder that we are in earnings season. So here was a tweet that I retweeted over the weekend from Earnings Whispers. They do a great job of kind of keeping us informed what stocks are reporting earnings and which ones aren't. Anyway, we did have Wells Fargo and JP Morgan report earlier today. Remember that tomorrow we've got Bank of America, we've got Goldman Sachs, we've got BlackRock, BNY Mellon, we got PNC and US Bank Corp along with Comerica. So we've got a huge slate of banking earnings in the morning. So just be aware of that in case you have any financial trades going on right now. This is the big financials week, and it doesn't end there. Remember, we got Morgan Stanley and BB&T and KeyCorp and Commerce Bank and M&T, American Express, and even on Friday you get some banking action there with Regions and SunTrust. So this is a huge financial reporting week that we have here as we kick off earnings season. The good news is, so far, those banks have largely been holding up okay. Citigroup came out yesterday. Their stock did go up after that announcement. JP Morgan initially sold off this morning, but then came rallying back with the rest of the market throughout the day. Wells Fargo still stayed in a bit of its funk there as the conference call let folks know that they were still not in the good graces of regulators, and regulators were still not going to allow Wells Fargo to grow throughout the rest of this year. And then they'll kind of reconvene next year. So they're kind of still in the penalty box, so to speak. But the good news is Citigroup and JP Morgan did see some positive price action after their releases. And remember, that had been different than what we experienced in 2018. A lot of times in 2018, investors of the banks sold first and asked questions later. Now it almost seems like, okay, they've been beaten up bad enough where even reasonably decent news is enough to send the stocks higher. So hopefully we get a little bit of a reversal there, because that was really one of the big wet blankets of the entire market last year, was those big banking stocks. All right, so let's go ahead and take a look now at our trade application example for the day. And what I wanted to do for this one is come on over here to chart. Let's do 4A for this. And let's go on over here to ticker symbol BOX. Yes, that's Box. Not Dropbox, but one of their competitors, Box. And this is a company, as many of you are aware, that did do an IPO here a few years back. And so it's still a somewhat newer company to the stock market. It's not Microsoft or Amazon or anything like that, so some of you might not be as familiar with it. But just to give you a little bit of heads up as far as what it has their trading history look like, let's take a longer term view here real quick at a 1-year chart. I just want to show you that, last year there was an appealing time for Box shareholders between, let's call it, April and mid-June, where it had a nice little run there. But since then, it's really been kind of sold off more often than not, right? There's a long series of lower highs and lower lows. Well, obviously, if a stock is ever going to go back into an uptrend after having been in a downtrend, it's got to form a bottom of some sorts. And that is what I'm wondering if it's taking place right now. Now, we don't know for sure, but at least we see some positive reasons to believe why that might be the case. And so let me zoom back in now and look at just the 3-month view rather than the 1-year view. And a couple things that I wanted to point out for you. First of all, notice that we do have a strongly bullish posture according to the market forecast indicator. We also have price above a rising moving average, which is why that moving average is also colored green in this particular case. We also have all of our market forecast lines heading higher. And I know it's hard to see this orange dotted one. We don't really concentrate or stress that one much during our videos because it is kind of geared for the longer term mentality, but that is our market sentiment line. And remember, even if you can't see that line real good, you can still read it right here in the labels itself. And you can see that that market sentiment line is at 26.75 and rising. And as most of you are aware, when it gets out of that lower reversal zone, rises above 20, that is perceived to be positive for the long term as well. Again, this video tends to concentrate on the more active crowd, so we focus on these other 3 lines instead. But for those of you that are a bit more long-term oriented, maybe you will appreciate the fact that the orange market sentiment line has now emerged and is giving us some bullish indications as well. Well, as you look at the price action above here, you're probably saying to yourself, yeah, that looks like it's pretty much sideways. And I would tend to agree with you. This is a stock that looks to me to be in a sideways channel at the current juncture, where we topped out at about $20.14 back here, and we bottomed out at about $15.64 here. You'll notice that this $15.64 bottoming out was very, very close to where we bottomed out on this particular candle as well, setting up the possibility that, perhaps that is a double bottom right there. You'll also notice at that time we had an oversold cluster signal that allowed for that opportunity for that reversal to the mean that we ultimately did see. Remember, the oversold cluster signal occurs when we get all 3 of those market forecast lines, in this case the blue, the red, and the green, all in the low reversal zone on the same day, and we expect some sort of a reversion to the move type of or reversion to the mean type of a move. So it's good to see that that played out, but like so many of those moves, it didn't ultimately go directly into an uptrend after that, right? It would be a lot to ask for one indicator to turn an entire company around that's been in a downtrend for a year. Instead, what happened is it did have that reversion to the mean move. It kind of topped out around this level, came right back down to test that same area, and decided, yeah, this feels like it's value territory for this particular company, or at least that's the mentality of the market participants on those 2 days. And that's where we find ourselves now, another bounce off of it. But the problem is, we haven't broken out above some of these key resistance areas either. So while we can say, yeah, it's a positive sign that we've now kind of put in a double bottom and established at least an understanding of where we expect the floor to be for the company, we haven't necessarily broken out above the ceiling either. The other thing that I would point out is that it almost appears like we have an inverted head and shoulders pattern of sorts forming here as well. Now, there's a couple different ways you could look at this, and remember, technical analysis is often in the eye of the beholder. So if others of you see it differently, that's completely fine. We all see things differently when it comes to technical analysis, but you can see a bit of a left shoulder over here that I'm kind of circling with my mouse right now. You can see obviously a head down here at the low like it normally is, and then we kind of go up and we dip down, and we're almost starting to establish the right shoulder over there. And remember, an inverted head and shoulders pattern is a reversal pattern where if it breaks that pattern to the upside, you expect the move to have some decent trajectory as far as where your price target would be. Remember that you will typically measure between the neckline of the pattern. In this case, let's call it up here, I don't know, about 20 or so, and the head. In this particular case down here at about, let's call it 1564, that's where the low price is. Some of you might use closing prices. There's no specific way that you need to do that, but that's the general theory is, okay, we're stuck in this pattern where we have a very obvious resistance area. We also recognize that the prior path of lower highs and lower lows is no longer occurring. And this is the chart's way of saying, yeah, rather than coming back down here and putting in a new lower low, we are going to put in a higher low, which in this case could be forming right here, and now is bouncing from those levels. And if it bounces out and breaks out above some of these resistance areas here, then your expectation is that it could have, let's say, about $4.50 worth of upside potential. And again, that $4.50 where I'm getting that is the distance between the neckline of this pattern and where the head is here. So basically between here and here is around $4.50. So what I figured what we would do today for this is do kind of a conditional style of an order where we say, okay, we're not convinced this thing is actually breaking out yet. We recognize the setup is there and the possibility exists, but it's not actually happening. So we can place an order that says, okay, when it does break out above resistance, if that is going to occur, then get us into the trade. And if that does occur, get us into the trade at a level that we're comfortable with and allows for plenty of upside potential. So if we have about $4.50 that is the kind of the deepness of this particular pattern, then our price target to the upside would be about $4.50 as well. So in doing that math kind of ahead of time here, what I established was we would try to get into this trade slightly above where it topped out back here. So we'll put in the trade. If it breaks up above 20, let's say 15, so a penny above the high point over here, then we'll try to get into the trade. And at that point, we would then put in a price target to get out to the upside at about $24.66. And again, that's about $4.50 above the breakout point there to kind of account for, how much risk we're taking. Again, the idea is to have a one-for-one risk versus reward mentality there, where if we're going to give up a potential $4.50 to the downside because we put our stop loss way down here, then we want to have at least $4.50 worth of upside potential to make sure that we're getting rewarded enough for the amount of risk that we are taking. And so if you kind of want to glance at that on a 6-month basis, 24.66 would be up kind of in this vicinity here. So it would basically say, okay, we recognize a bottoming process taking place here, and if it does break out to the upside, we're going to target kind of this area up here, which is right thick in the middle of this kind of congestion zone that we saw back here in the fall of last year as well. And so perhaps there are other sellers and other reasons why that might make it a good price target as well. So in order to initiate that trade, what I'm going to do here in paper money is just right click on the chart. I'm going to come down here to buy custom. I'm going to choose with OCO bracket. So that loads up my trade down below. I'm just going to leave this with a generic 100 shares here, but obviously you're going to need to position size according to however big your account is and how much risk you want to take. But for paper money purposes, I'm just going to leave it right there at 100 shares to make it nice and simple to understand. Now on this top line here in the order itself, in green, I am going to change this from a limit order to a stop limit order. Now what I'm doing there is I'm saying that I need this stock to go up before I want to buy it. Remember, that's a bit of backwards thinking for a lot of folks that think, oh, I only want to buy a stock if the price goes lower and I can buy it cheaper. That would be your more traditional buy limit order. This is a buy stop saying, yeah, we actually want the stock to go up and we actually want to pay more money per share for it, because at that point we can convince ourselves that it is breaking out above resistance. So what we're going to do in this particular case is we're going to establish our stop price at $20.15. And we're also going to put in our limit order of, let's just call it $20.19, giving ourselves a little bit of flexibility there, because remember, when your stop gets kind of triggered, there is the possibility that the market is moving very, very quickly at that time. So we're saying, yeah, we're willing to give up a few pennies there because we don't want to quibble over a few pennies, but we don't want to give up, let's say, $1 per share and just put in a market order, and you come to find out that the stock's getting a buyout offer and it's moving by 50-cent integers at that point. So it's just a way to kind of protect yourself a little bit more. But also remember, there's a downside to that. If the market is moving very quickly and that thing ticks to 2015 and the very next tick is 2020, then even our trade here at 2019 might not get filled. So be aware that the more that you kind of adjust your trades, the lower the chances that your trade gets filled as well. There's always pros and cons to every decision you make. I am going to come over here and change this to a good till cancel order because I don't assume that that's going to happen tomorrow. Remember, the stock is trading at 1933 right now. Now, on the first pink line that you see here where it says sell minus 100, that's going to be our price target to the upside. And so for that, that's what I was mentioning before. If we kind of, take a look at where our head and shoulders pattern would be and then kind of convert that into a price target to the upside, that would be at $24.66. Or at least that's where I kind of measured it. You can measure it slightly differently, of course, but that's about the general vicinity. So that's where I'm going to present it here for this trade example. Off to the right-hand side here where it says day, I am going to change this to a good till cancel as well, because again, we don't want that part of the order getting canceled immediately after the very first day of its life. in all likelihood, if we do buy that at $20.19, it's not going to go to $24.66 in one day. So we need that order working for us day after day after day. So we change that to good till cancel. Now in the next line directly below it, since we're over here and talking about it, let's change that to good till cancel as well, because that will refer to the stop on the downside, right, in case we're wrong. And for that, I am going to put in our order at $15 and let's call it 63 cents, or in other words, 1 penny lower than where the low price was for this stock here. If it touches down below there, clearly it's going into a downtrend again where it's hitting fresh set of lower lows at that point, and therefore we're wrong, right? And we will be wrong plenty as traders. We have to kind of make sure that we are accounting for that risk of being wrong, and by using a stop loss, that's exactly what we're hoping to accomplish here. So that is how you set up that trade. Let's go ahead and click on confirm and send and review this one last time. We're trying to buy 100 shares of Box at around $20.19 if the stock goes up to those levels, but only if that happens. If that does get filled, then we want to put in a new set of trades here that are going to identify our price target at $24.66, where we would sell our 100 shares up at that level and profit if that were to unfold. Otherwise, if it doesn't unfold and the stock ultimately goes lower after we buy it at 2019, then we don't want to take on too much risk, so we decide we're going to get out at $15.63 at that point. So I'm going to go ahead and send that in, and we'll see if we get filled on that first thing in the morning. All right, well, I want to thank you for being part of the audience here tonight. Thanks for checking out these videos as always. If you got value out of that, make sure that you click like and retweet for us on Twitter. It's your way to let us know that you want us to continue these videos going forward. As always, I want to wish you the best of success with your trades and your investments. Goodbye for now.